The EU's economy grew slightly less than expected from April to the end of June amid soaring energy and food prices. In the second quarter, the bloc's gross domestic product increased by 0.6% compared to the first 3 months of the year, according to the latest official figures. The economies of the Netherlands, Romania and Sweden grew exceptionally strong, while Germany's stagnated. Europe's largest economy is feeling the pain of reduced Russian gas flows. Fears that gas rationing could devastate the German economy are rising. Now, the International Monetary Fund has warned that Europe's industrial powerhouse is exposed to the biggest economic risk from the fallout of the war in Ukraine. Ferdinand Fichtner is an economist at Berlin's HTW University of Applied Sciences. Let's get his view on this. Welcome back to the program, Ferdinand. So we have 0.6% growth in the EU as well as in the Eurozone. What do you read in these growth figures?
It's a bit of a mixed picture, as you said in your introduction. We have relatively strong growth in Southern Europe and weak growth in Northern Europe, or in Germany in particular. And in that sense, it's a bit a mixed picture. I guess what we can read into that is that the high uncertainty in the current situation is making life particularly hard for countries as Germany, who are producing machinery, for example, investment goods in general, because uncertainty is always a bad thing for investment, obviously. And this is what is dampening growth in Germany, so to say.
And speaking of these risks, we have the warning of the IMF saying the German economy is most exposed to these fallout risks of the war in Ukraine. And there has been data showing that the German economy already contracted slightly in July. So how big is the risk for Germany here?
I think we don't see too much in the current figures yet, but the outlook is definitely extremely weak. I think we should expect for the second half of the year, for the third and fourth quarter, we should expect negative growth. And this is obviously related to the current situation in Eastern Europe, but also related to supply chain interruptions with China. We currently hear about massive problems in China in terms of economic production, and all these aspects play a major role for Germany, which is highly dependent on its exports, and therefore and also on its imports. Actually, imports of gas, imports of semiconductors, and all these things we are exporting from the Near East, like Eastern Europe, and the Far East, like China.
Ferdinand, at the same time, the German government says 2 floating liquefied natural gas terminals will be operational starting in the wintertime. The country's gas storage facilities are 75% full. What do you see regarding this scenario when it comes to energy supplies for the country, for the economy in Germany?
I think most people are maybe hesitatingly optimistic about this. I think what we're definitely seeing is that the German economy, that German firms, but also private households, are able to reduce their gas consumption. And I'm sure we can expect stronger reductions if the price increases, which are to be expected for the second half of the year, fully kick in and fully affect households and firms. But there is still a way to go, to be honest. We still have to reduce by some more than 20%. And this means, translating it into households' daily life, means we have to reduce the temperature in our apartments by some 2 degrees Celsius. And that is something you will feel and notice. And I'm really uncertain if people are able and willing to reduce their gas consumption by that much.